Hi there. CVS has recently reported the results for the second quarter. And based on their guidance and also the analyst estimates, the stock price seems fairly valued at the current level. And of course, you also get a nice dividend around 3%. So in this video, we'll find out the outlook of CVS, and at the end, its fair value. Let's begin. You can see in this image the analyst estimates and the past numbers. As you can see, the earnings have declined in 2022, from about 8 billion to 4 billion. And that's why the stock price has declined so much, over 40%. And if you are wondering why this decline has happened, well, the answer is here. They had some opioid litigations, about 5.8 billion, plus a loss on assets held for sale, around 2.5 billion. And because of these expenses, their earnings were lower in 2022 and the stock price went down. Now for this year, the earnings are expected to rebound to 9 billion and then to grow more in the future to almost 14 billion by 2027. So that's great. The value of CVS will increase even more in the future. Same for the revenue, which is expected to increase from 322 billion to over 400 billion by 2027. Plus, you can also see their free cash flow, which is expected to be around 10 billion for 2023 and 2024 and 14 billion in 2025. So that's great. Moreover, their dividends are expected to increase more in the future, from $2.20 to $2.90 by 2027. That will be a dividend around 3.7% at the current stock price. Of course, if they make more money, then the dividend will be higher. Now, for the second quarter results, the revenue was up 10%. They made around 88 billion. The problem is, their earnings were down 45% year over year, and their cash flow from operations up 8.5%. However, despite this decline, they still expect over 8 billion in earnings for 2023. If you look at their guidance, you can see that they expect over $6 per share in earnings, and the revenue to be around 350 billion. Plus, if you want to know their growth rate segment by segment, you can see that the revenue for healthcare benefits was up 17%. For health services, revenue was up 7.6%. And for pharmacy and consumer wellness, the revenue was up 7.6%. So that's great. The only problem was their earnings. They had higher expenses, and that's why you see this decrease in their earnings, over 40%. And in the second quarter, they completed the acquisition of Oak Street Health. They issued 5 billion in debt to repay their loan and returned to shareholders almost 800 million in dividends. So that's great. Of course, there are also some problems with this business, which is their long-term debt, about 61 billion. But if you look at their balance sheet, you can see that they have 14 billion in cash. Their investments are about 3 billion, plus their long-term investments over 20 billion. And if you add them up and subtract from their debt, their net debt will be around 20 billion. So that won't be a big problem for CVS, as they are expected to make around 10 billion in earnings, and even more in the next 5 years. Now let's see the fair value of CVS. First, the risk. For a 10% annual return, the fair value will be around 82 billion. If their growth rate slows or declines, you can expect another decline in the stock price. Not that high, but the fair value per share may be around $64. And now it's around $74. So this may happen. It's not a high risk, but we have to be aware of this decline, because other litigations may occur in the future, as there were with those opioid claims. And the great scenario, if CVS keeps growing more in the future, their earnings improve from 9 billion to 14 billion, and they keep growing more, then the fair value may be around 150 billion for a 10% annual return. So this may also happen. The stock price may rebound to over $100. As you can see, the fair value per share may be around $118 for a 10% annual return. So at that level, you can expect 10% a year on your investment, including dividends. In the normal case, the fair value may be around 99 billion if CVS delivers the expected numbers. So the current level CVS seems fairly valued for a 10% annual return. Of course, the stock price may decline in the short term, but this dividend is quite sustainable because CVS is a pharmacy, they provide other healthcare services, and it's a stable business. So if you like this type of business, what they do, CVS seems as a good investment. Now you also have to be aware of the risk, because other opioid claims may occur in the future, which can make their profits decrease, and that can affect their dividends to decrease a little. This is the worst case scenario. I don't know if that will happen again, but you have to be aware of this risk. So it's up to you if you like CVS at the current level and the return you get on your investment, 10% a year. If you want more, you can wait for another decline. For instance, in May, CVS was an even better buy, but still at the current level, it's a good investment. If you want more, you can search for other investments. And if you have any questions, please let me know in the comments.